This video explains the 2026 to 2027 tax treatment of electric cars and vans used by business owners. It starts with the business structure, whether the vehicle is a car or a van, and how sole traders and partners claim business mileage and running costs. It then covers business use deductions and the different capital allowance routes for new cars, used cars, and electric vans. For limited companies, it shows electric company car calculations, charging rules, and electric company van treatment. Finally, it compares the tax advantages with the practical commercial factors that affect the decision. Electric vehicles receive some of the most favorable business vehicle tax treatment in 2026 to 2027, but the result still depends on the business structure and on whether the vehicle is a car or a van. For a sole trader or individual partner, private use does not create a benefit-in-kind charge for the owner. The business claims only the business element of charging, insurance, repairs, servicing, lease payments, and other qualifying costs. Alternatively, an eligible business may use simplified mileage. For 2026 to 2027, the rate for an electric car or van is 55 pence for the first 10,000 business miles and 25 pence for each business mile after that. The examples use the 20% basic rate and 40% higher rate for England, Wales, and Northern Ireland. Scottish taxpayers should use their relevant Scottish marginal rate. Assume a sole trader's qualifying electric car running costs are £8,000 and reliable mileage records show 75% business use. The starting business deduction is £6,000. The remaining £2,000 relates to private use and is not claimed. Where the vehicle is owned, capital allowances are calculated separately and are also restricted for the private use proportion. A qualifying new and unused zero-emission car can receive a 100% first-year capital allowance. For corporation tax, the extension runs to the 31st of March 2027. For income tax businesses, it runs to the 5th of April 2027. A second-hand electric car does not receive that first-year allowance and normally enters the 14% main rate pool. Sole traders and partnerships restrict claims for private use. Electric vans are normally plant and machinery and may qualify for the annual investment allowance. Companies may also have access to full expensing for qualifying new vans, subject to the detailed rules. When a limited company provides an electric car to a director or employee, and it is available for private use, the 2026 to 2027 zero-emission company car percentage is 4%. The calculation still uses the tax list price, including taxable accessories. A purchase discount or low lease rental does not normally reduce that list price for benefit purposes. Take an electric company car with a tax list price of £50,000. 4% creates a taxable benefit of £2,000. A basic rate taxpayer pays £400 for the year. A higher rate taxpayer pays £800. The company pays Class 1A national insurance at 15%, which is £300. Now take an electric car with a tax list price of £80,000. At 4%, the taxable benefit is £3,200. Personal tax is £640 at 20% or £1,280 at 40%. The company pays £480 of Class 1A national insurance. Electric company/car tax is low compared with many petrol and diesel cars, but it is not zero. Electricity is not fuel for the separate company-car fuel benefit charge, so the £29,200 car fuel multiplier does not apply to electricity. Workplace charging and charging connected with a taxable company car can often be provided without an additional fuel benefit. Businesses should still keep clear records for home charging, public charging, business mileage, and any reimbursements, because the treatment depends on who owns the vehicle and how payment is made. Under the normal van benefit rules, a zero-emission company van has a nil taxable benefit, even where it is available for private use. It is reported at 0% of the £4,170 standard amount. Electricity does not normally create the separate £798 van fuel charge. Compare this with an emissions-capable van, where unrestricted private use can create the full £4,170 benefit. Private petrol or diesel can create the additional fuel benefit. The vehicle must genuinely be a van for tax. A manufacturer's description or commercial appearance is not conclusive. An electric car can combine a low 4% company car benefit with strong capital allowances for a qualifying new purchase. An electric company van may produce no normal van benefit at all. However, compare the tax result with the commercial position, including vehicle price, insurance, charging access, expected mileage, range, downtime, and resale risk. Salary sacrifice also has separate rules covered in the next video. For a tailored review of your business vehicle position, contact ABC Business Services. You can speak directly with a member of our team. Email us to arrange an appointment, or visit our website for more information.